Hi guys and welcome. This is the second part of the series, the webinar series on the 10 essential components to successful trading. We're talking about the 10 habits of highly successful traders here. These are the things that I've been studying, that I've been using in my own trading for the last 8 to 10 years now. And I think that you'll find them highly effective for your own trading as well. And we're going to go into more detail on the aspects of technical analysis in trading in this particular part. We're going to be looking at, what repeating patterns can we see in price action that give us a clue as to the probability of prices going up or prices going down. And that's what's going to enable us to make some money from trading. That's what the professional traders do. They assess probability in the market moving in one way or another, and they look at these repeating patterns in price action and aspects of price action like support and resistance, candlestick patterns, things like that, chart patterns. They look at these things and they assess probability. And over a period of time, it's the assessment of probability and getting the assessment of the direction correct more often than not, that lead to success in trading. So we're going to go into more detail in those aspects in this particular video. And I'd encourage you to write notes. This is highly technical stuff. Write some notes and ask questions. Go ahead and subscribe to the channel and ask some questions, because I'm going to come back and answer the questions at some point in time in the future on a regular basis. I'll be back answering your questions, so go ahead and ask. And I look forward to taking you through these aspects. This is my forte, technical analysis. I look forward to sharing some of my thoughts and some of my insights with you. So here we go.
Your trades must have more than one thing going for them. Your trades must have context, they must have content, and they must have confluence. And this is a concept that I've come up with myself, that I use in my own trading and that I teach other traders. And beginners tend to learn certain candlestick patterns or chart patterns or an indicator behaviour, and they think that they can just look out for this to appear on their chart, take their trades, and that it'll be game over, it'll be a win to them. And they are right about one thing: it will be game over, but it'll be game over for their trading account if they do this, because successful trading is slightly more complex than that, and it involves taking opportunities involving several different components saying the same thing at the same time. I've spent hours and hours testing candlestick patterns and chart patterns and indicators, and I'm telling you now, there's no consistency in these patterns. They work sometimes and they don't work on other occasions, and there's no magic formula involving any one tool that works sufficiently well to enable traders to rely on them on their own to produce profitable results. Successful trading strategies involve the use of lots of different tools and resources at once and employing them together to form a strategy that works consistently. And this is one reason why trading is so tricky and challenging at first. All information on a trading chart is produced by price action and by volume, and it is possible to just use price action on its own, but you'll need to pay close attention to additional factors other than just the candlesticks or just the lines on the chart, to other additional factors like support and resistance levels, trends and trend lines, rather than just these candlesticks by themselves. And when several factors all say the same thing on a trading chart, then you can say that you've got confluence for your trade. So your trades must have context, they must have content, and they must have confluence to be effective within a profitable trading strategy.
What we're talking about here is doing the duck test on your trades. And the duck test taps into the potential of the human brain to use intuition to deduce a likely outcome. It's been in use, the duck test, to identify
possible criminals in the USA. And by the UK HMRC, the tax authorities here, as a test for how they may identify a company for tax purposes. And the duck test goes like this. If it looks like a duck, if it swims like a duck, and if it quacks like a duck, then it's probably a duck. So does the trade setup, in our case, does the trade setup have context, content, and confluence? It's the same principle, isn't it? Let's have a look at context first then, because context is something that gives you a guide as to where price is currently in relation to where it's been in the past and the type of trading conditions that the market is in at the moment. In terms of market conditions, I'm talking about, is the market trending upwards, downwards, or is it in a trading range? If it's in a trading range, then how wide is the range? If it's trending, then what stage of the trend is it in? Is it in the breakout phase or is it in the trend channel phase? And I'm going to go into more detail on these type of things later, but these are things that are important to be aware of because they'll allow you to put the current price level in context with previous prices and help you judge the probability around the likely direction that price will take in the future. Is price around about its mean value, or is it overbought or oversold in relation to where it's been in the past and in relation to what it's been doing in the past? And again, this helps to provide judgment on probability around where it'll go next, whether it'll go up, down, or stay at a similar sort of level. And again, more on this later. Are there any previous highs or lows at the same level that price is currently at? That will give you context. And in certain circumstances, this may lead to the market reversing. In other cases, it'll merely pause here before carrying on its journey. So that's context. And the second thing is content. Each trade needs to have content, and content's gained from the content of the price bars or candlesticks and the combination of several price bars together. And here I'm referring to things like candlestick patterns, single bar candlestick patterns like engulfing candlesticks, pin bars and dojis. And I'm also referring to combination patterns like fake outs and morning and evening star patterns. Perhaps several concurrent or consecutive bull or bear candlesticks and things like that. So content is gained by examining the movement of groups of candlesticks. Are they making higher highs and higher lows, indicating an uptrend movement? Or are they creating lower lows and lower highs, indicating a downward movement? And what about the closes on bull bars and the closes on bear bars? Is the market getting stronger or weaker in one particular direction? Or is it in relative balance? So that's content. And then thirdly, confluence. Each of your trades must have a confluence about them. And as I've already alluded to, confluence is gained when several indicators or several things say the same thing at the same time. When you make a judgment on what you think the market is going to do, which direction you think the market is going to go in, then just ask yourself the question, what else is there that agrees with my analysis? What else is there to back up my thinking? And confluence can be gained from all sorts of things like chart patterns, double tops, double bottoms, head and shoulders, tops and bottoms, that sort of thing. It can also be gained from value extremes. More on that later. Indicators, risk and reward opportunities in relation to your position size, your maxed win and your max loss rules. Higher time frame analysis, Dow trend change analysis, the position that the market is in relation to the market cycle. The list can go on, and basically as long as you have something tangible and measurable that also agrees with your trade or your market analysis, then you can say that you've got confluence. Confluence adds weight to the probability that your assessment is correct. And when you've got context, when you've got content and confluence all aligned in one direction, then you've got a potential trading opportunity. Your trading strategy, your overall trading strategy, should include criteria for each one of these three things. And if it has, then it's got a good chance of being successful and profitable.